Today we are going to start with the lecture on financial accounting, and this is the initial lecture where we are going to discuss about the accounting concept and related terminology. The term financial accounting is made up of two different words, that is financial and accounting. The word financial refers to something relating to finance or simply money, and the word accounting refers to account for or simply make a record. So, in its simplest terms, it implies that when we record the activities of financial nature undertaken by us, the process is termed as financial accounting. Business is basically an activity which is economic in nature and is undertaken with the objective of increasing wealth. In course of business, a large number of activities are undertaken in order to earn profits. All these activities of business are business transactions. These transactions takes place on regular basis and are either financial or non-financial in nature. Maintaining a systematic record of all business transactions, at least those which are financial in nature, is required for various reasons. This laid down the very foundation of emergence of financial accounting. So, in literal terms, financial accounting is a process of recording financial transactions of an organization in a specific format in a particular set of books. It is related to only those transactions of business which are financial in nature. That means, can be expressed in exact monetary terms. The transactions of similar nature are grouped together at a later stage and then summarized in order to calculate the profit or the loss generated due to activities undertaken by the businessman and to know the financial position of the business. So, over a period of time, the scope of financial accounting function has increased from mere recording of financial transactions to the extent of interpretation for the purpose of decision making. Now, we will talk about some important definitions given by various renowned experts and institutions relating to this discipline at national and international level. Accounting is the art of recording, classifying and summarizing in a significant manner and in terms of money transactions and events which are in part at least of financial character and interpret the results thereof. American Institute of Certified Public Accountants has given this definition. Second definition reads out like this: accounting is the process of identifying, measuring and communicating economic information to permit informed judgments and decisions by users of information. This definition comes from American Accounting Association. Then the next definition is like accounting is a service activity. Its function is to provide quantitative information, primarily financial in nature and about economic activities, that is intended to be used in making economic decisions. This is the definition given by American Institute of Certified Public Accountants. Likewise, the next definition reads out as if an accounting system is a means of collecting, summarizing, analyzing and reporting in monetary terms information about the business. This comes from R.N. Anthony, and next is from Harold Behrman, which says that accounting may be defined as the process of identifying, measuring, recording and communicating of financial information. Going through these definitions, we can sum up like that: the accounting can be said to be the function of a business which identifies the financial information, measures and records it, calculates results and explores financial position on its basis, and then communicate this information to its end users so as to facilitate its interpretation and analysis. Though basically it was the limitness of human memory that created the foundation for emergence of financial accounting, there exist a large number of factors necessitating the need of accounting function for business. The important ones are discussed: limitness of human memory. We all know that human memory is limited and it cannot keep a track of all given information like computers. In course of business, a large number of transactions are undertaken on regular basis, and it is practically impossible for a businessman to memorize all the transactions. So, accounting is needed. Calculation of results of business activity. Any financial activity is undertaken with the basic objective of generating more wealth. So, it is very important to know the results of the financial activities undertaken by business and other organizations. Accounting function helps the businessman to calculate the profit or loss of the business, thereby facilitate the knowing of results of business activity. Exploring financial position of business. Business is started by investing money from various sources. So, it is very important to know the increase or decrease in this investment and also the structure of the money, that is in terms of assets and liabilities of business. So, it is very difficult to know about the position of a business at any point of time, as it changes with every next transaction. Through certain statements prepared in course of accounting function, a businessman is able to know the financial position of the business. Control on business activities. A business involves large number of activities and it is very important for a businessman to execute control on it. This is required to meet the basic objective of business. Accounting function summarizes the various similar transactions and thereby facilitates control on business activities. For example, with the help of list of credit sales, a businessman can exercise control on customers from whom money is to be collected. Improvement of future performance. Financial accounting provides records of business transactions of past in a systematic format. By conducting a SWOT analysis of business records, a businessman can explore the strength as well as the weaknesses of the business. By maintaining its strengths and overcoming its weaknesses, a business can improve its future performance. Next, future planning. Accounting function generates data and records relating to past performance of the business. These data and records create a basis for analysis and interpretation. Based on this analysis and interpretation, a businessman can plan for its future activities in a better manner. Statutory requirements. Meeting statutory requirements is also one of the important factors necessitating accounting function for a business. Maintaining and submitting accounts is compulsory for a business under various laws and statutes like Companies Act 1956, the Income Tax Act 1961 and so on. So, accounting function is also needed to meet the statutory requirements. Then comes various reasons. Accounting function generates a systematic and permanent record for all future references like disputes between business and other parties, legal suits, etc. Similarly, accounting records facilitate procuring a loan from bank or from any other financial institution. Accounting data is also required by scholars and researchers for real life research work. Before we get into the greater details of accounting, we should make ourselves conversant with basic terminology that is used in accounting. So, we will be talking about the key terms that are used in accounting. First is capital. Capital is the contribution made by businessman himself in business out of his personal sources. Whenever a person starts a business, he invests some amount from his own pocket. This money belonging to owner of the business is known as capital. In a corporate organization, capital is divided into small tradable denominations of equal amount known as shares. So, capital of a corporate organization is known as share capital. Against capital, we have drawings. Drawings refers to the amount which is withdrawn by owner from business for his personal purpose. Drawings may be in cash or in kind. Even if a business earns profit and owner withdraws a part of it, this will amount to drawings. In corporate organizations, drawings is not possible as there may be hundreds of owners which contribute the share capital. Let us talk about liabilities now. Against capital, liabilities are contributions made by outsiders to the business. They are the obligations upon business to be discharged in near or later future. According to accounting concepts, contribution made by owner is also recorded as internal liability. But for the sake of our discussion, we are treating only external liabilities as liabilities. Let us have an example on liabilities. Let us say if a businessman takes a loan from his friend, maybe relative or maybe some bank. So, this amount of loan taken for business will be a liability for business. Now, liabilities can broadly be classified in two parts. Either they are short term liabilities or they are long term liabilities. Long term liabilities will be those which are repaid back after a longer period of time, normally more than 1 year. While when we talk about short term liabilities, which are also popularly known as current liabilities, they are to be repaid normally within a year's time. Let us have an example on long term liabilities. I told you earlier about the bank loan, mortgage loans, secured loans, all kind of long term loans are long term liabilities. If you talk about company, debentures issued by company are an example of long term liabilities. While on the other hand, if you talk about short term liabilities, these are dues to be paid within a year's time and include liabilities like dues of suppliers, the people who have supplied us goods on credit, bank overdraft even, expenses due but not paid, that means outstanding expenses, all these are our short term liabilities known as current liabilities. Now, let us talk about assets. Assets are the resources of the business which help in smooth conduct of business activity. Some assets help the business in day to day activity, while the others help the business in long run by strengthening the infrastructure. Like liabilities, assets can also be classified as long term and short term. Though long term assets are known as fixed assets, short term assets are known as current assets. Fixed or long term assets are those which remain in business for a longer period of time, normally more than 1 year, and are not meant for resale or conversion back to cash in the normal course of activity. These assets strengthen the infrastructure of the business. Examples of fixed assets are building, machinery, furniture, etc. On the other hand, current or short term assets are those which remain in business for a shorter period of time, say up to 1 year, and are meant for conversion back to cash in normal course of business activity. These assets facilitate day to day business transactions. Cash, stock, goods, dues from customers, all these are example of our current assets. Now, here comes a very important term, voucher. Voucher is basically a documentary evidence, a proof, a paper proof you can say, that certifies the existence of a business transaction that has been recorded in books of accounts. Let me tell you here that without voucher, accounting record has no validity. So, voucher is very important. Every transaction recorded in books of accounts of a business must be supported by a documentary proof. This documentary proof can be a bill, a receipt, a check, or any authorized piece of paper which justifies that transaction has happened. The documentary proof is known as voucher. Traditionally, vouchers are physical in nature, but now with the advent of information technology stepping in each and every aspect of modern business, even e-voucher is not an unknown concept. Now, let us talk about again something very important, accounting transaction, because entire accounting is based on something known as accounting transaction. Now, you know what is transaction? If you and me are dealing, we have something, a deal, a transaction between us, we call it a transaction. We interact, we communicate, we exchange goods, these all are transactions. Similarly, in course of business also, a businessman interacts with other parties on regular basis. But then every transaction is not an accounting transaction. not even a business transaction. That means it brings you to 3 different terms: business transaction, accounting transaction, and simply transaction. Now, what is the difference between these 3? Let us say when you have a transaction with you, if it is related to business, it is a business transaction, but then is it an accounting transaction also? It will be decided by the condition that is this business transaction monetary in nature? That means there are 2 conditions to make something an accounting transaction. One is the transaction should be related to business, so that means it is a business transaction, and secondly it must be measurable in terms of money. So, business transactions which are measurable in monetary terms becomes accounting transaction. So, that means we can conclude it like this, that the business transactions which can be expressed in exact monetary terms and are hence recordable in books of accounts are our accounting transactions. Only accounting transactions will go in books of accounts, and other business transactions will have no place in the books of accounts. Now, let us talk about sundry debtors. Debtors are basically the customers of the business to whom business has sold goods for credit and payment is not yet received. That means, a businessman may sell goods for immediate payment, that is cash sales, or for deferred payment, that is credit sales. The customers buying the goods for credit are debtors of the business till the time they settle the dues. Once they settle the dues, they are no more debtors. Debtors are our short term, that is current assets, as we discussed, short term assets are current assets, and business has to collect money from them, so they are our assets. As there can be large number of customers from whom money is to be collected, we call them sundry debtors. So, all debtors put together are known as sundry debtors. Connecting term is bills receivable. Now, when you talk about bill, you must be aware that bill is a negotiable instrument where one party promises something to other party. In terms of business, bills receivables are transformation of part or even full amount of the debtors. Some of the customers who are normally new to business execute a negotiable instrument called bill in the favor of business, promising to pay the amount on presentation of bill at a certain future point of time. The period normally range from 30 days to 6 months. As business has to receive money against these bills, these are known as bills receivables. The names of such customers is removed from the list of sundry debtors and included in the list of bills receivables. So, like debtors, bills receivables are also current assets of the business. Both debtors and bills receivables put together are known as receivables of the business. So, this makes you clear about one party, that is customer. Connecting is bad debts, which talks about those customers who have purchased goods from business on credit, but they finally failed to pay amount, they did not pay the dues. So, they are our bad debts. It is a loss to business. Reason for non-payment is immaterial, whatsoever reason may be, the money is lost and that is our bad debts. Now, let us talk about the other party, that is creditors or suppliers of the business. When we talk about creditors, these are those suppliers from whom we have purchased goods for credit. Like to customers, when we sell goods for credit, they are debtors, and from suppliers, when we purchase goods for credit, they are our creditors. A businessman like sell can also purchase goods for either immediate payment, that is cash, or for deferred payment, that is credit. The suppliers selling the goods for credit are creditors of the business till the time business settle their dues. Creditors are short term liabilities, as business has to pay money which is due on this. As this can be a number of suppliers in this category, we can call them put together as sundry creditors. Now, let us talk about bills payable, which is connected to creditors. Bills payables are transformation of part or even total amount of creditors. As we discussed in debtors, customers write bill in our favors. In case of bills payable, we write bills in favor of our suppliers, right. I'll give you an example connecting these two terms that would be clear to you people. A business has to execute a negotiable instrument called bill in favor of the supplier. Normally, when supplier is unknown to us, he asks us to give a bill. So, we give a bill to him. Now, because business has to pay amount on this, so it becomes bills payable. Earlier it was we have to receive amount from customers. So, bill received from customer was bill receivable. Now, we have to pay amount to our creditors on bill. So, it is bills payable, right. And as we discussed for debtors and bills receivable, total amount of creditors and bills payable put together is known as payables of the business. Bills payable is also current liabilities, as we have discussed earlier. Now, let us I was talking about an example to connect this to. Let us say you and me are in a business, okay. You have a business, I have a business. Now, if you are selling goods for credit to me, what is happening is, in my books of accounts, I write you as a creditor because I have to pay you money. While in your books, what you are going to do is, you are going to write me as your debtor. That means, you have to receive money from me. So, you can see one transaction has two faces, but in two different books of accounts. One in the books of seller, the other party is debtor from whom money is to be received, other the purchaser who has to pay the money to other party, which is creditor in the books. Now, let us say once we have this transaction and you ask me to write a bill in your favor. As soon as I execute a bill in your favor, my name will be removed from your list of debtors and your name will be removed from my list of creditors. I will shift you from creditors to bills payable, you will shift me from debtors to bills receivable. So, in one book the same bill is recorded as bills payable, while in your book the same bill is recorded as bills receivable. So, it is the two faces of the same transaction. I hope that is pretty clear to all of you now. Now, let us talk about something very important, stock. Technically we call it inventory, but popularly you know it as stock. Inventory at a given point of time refers to the value of stock of different items in raw, semi-finished and finished form, which are being traded by the business. It is to remember that only those items which are merchandise of a business are considered in inventory. Value of assets and non-goods item like stationery etc. is not inventory. Simply speaking, inventory is monetary value of goods of business in terms of raw materials, semi-finished goods and finished goods sellable by business. Accordingly, inventory can be of three types: raw materials, semi-finished goods and finished goods. Raw material refers to inputs required by a producer for production of commodity that he sells. These inputs are finally converted into finished goods by production manufacture process. Second is work in process. It is semi-finished material, that means neither purely raw nor purely finished, between the lines. The raw material which has been introduced to production process, but the production is not yet completed. So, you call it work in process or semi-finished goods. It is commodity which is normally sold by business, what is known as finished goods. For a producer, you can have raw materials, semi-finished goods and finished goods, but for a trader who only deal in finished commodity, he has no raw materials, no work in process. Once raw material completes the production process, it acquires the form of finished goods. Let us have an example on this. If you talk about a firm in ready-made garment industry, what you can observe is the cloth that is available for stitching the garments is a pure raw material, but that part of cloth that is already cut in form of shirt, but not yet stitched, it is work in process because cloth is cut, but complete shirt is not ready. Once complete shirt is ready, that complete shirt is finished goods. So, likewise you can observe three forms of goods in different industries. Now, let us talk about purchases. When you talk about purchases, it refers to purchase of goods for the purpose of production of finished goods or for the purpose of direct sale in case of purchase of finished goods by traders. Traders purchase finished goods and sell them. It can be for cash or for credit. It is immaterial that goods under purchase are in raw or semi-finished or finished form. What is important is purchase is always of merchandise, that is goods and commodities in which business is dealing. That is only regarded as purchases. If you purchase assets like building, things like stationery, they will not be purchases. For example, if you take a stationery shop, stationery wala purchases stationery, it is purchases. But if you take some other business, let us say a pharmaceutical firm, if it purchases stationery for its own consumption in office, this stationery is not purchases, but it is only an expense on account of stationery. Let us talk about connecting term purchase return. When a business return the goods earlier purchased by him for whatever reason it may be back to the supplier, this return is known as purchase return. Again, like purchase return can also be for either cash or for credit. Again, remember here that merchandise only can be recorded as purchase return, not the other things or assets. Opposite side is another item called sales. You know sales? Normally we understand sales, whatever is sold by business is sales. But just understand that when a business sells goods and services in which it deals, then only you call it sell, whether it is for cash or for credit. It is immaterial that goods under sale are either raw or semi-finished or finished. Important is that it is the merchandise of the business that you are selling. If assets like furniture, building, etc. are sold, you do not call it sell. To the most you can call it sell of assets, but you cannot call it sales. Sales return is connected to sales whenever a business receives goods back from the customers, either for cash or for credit. Some of the customers may return goods back for whatever reasons. This amount of sale returned by business is known as sales return. It can be either for cash or for credit. Again, return of merchandise only back from customer is known as sales return. Now, after talking about these fundamental terms, a question that pops up to your mind is, do we have some difference in bookkeeping and accounting? We keep on listening about this term, bookkeeping, accounting. So, are these terms same or they are different? Now, for a layman, if you talk, it sounds same. Layman will always presume that bookkeeping and accounting are same, but in fact they are not so. Bookkeeping is comparatively a narrow term and it is part and parcel of accounting. That means accounting is a broader term and includes bookkeeping in it. Now, see this word bookkeeping, how does it sounds? There are two different words that connect this, that is book and keeping. That means this part of accounting is related to maintaining certain specific books of accounts, which is the initial phase of accounting function. Initially, accounting function is performed by maintaining certain books of accounts on regular basis and then summarizing them. This phase is known as bookkeeping and continues all the year round. After all the business transactions are being properly maintained and financial period is over, the job of bookkeeping is over, but accounting function still continues. The information recorded in books of accounts is processed for calculation of results and its communication thereof for interpretation and decision making. Now, let us talk about who all are the interested parties to use accounting information. That means, the users of accounting information. Although accounting is basically required for business operations and control, there are number of users who are interested in accounting information of an organization. These users of accounting information can be broadly categorized as either internal users or external users. Internal users include owners and management, whereas external users include all the other stakeholders. First is owners or shareholders. You know the owners who have invested money in the business. Now, as they have invested money in the business, they want to maximize their wealth. A company can pay dividend or return on its capital only when it's earn profit. Further, profits of organizations have an impact on the market value of shares also. So, they have a keen interest in knowing the profitability of business. Accounting statement provides them the required information. Second interested party in accounting information is the management. You know, the managers of the business organizations are responsible for performance of business and they are required to report to the owners of the business. So, the managers are highly interested in accounting information. Accounting books and records give them an insight into strengths and weaknesses of past operations, which can help them out to improve the future performance of business. Now, let us talk about the external parties. First in line is the investors. These are the people, the organizations who have invested in a business activity for various reasons. They are also interested in knowing about the performance of business, so that they can take decisions on continuance, withdrawal or further investment in the business. So, they require accounting information. Then comes creditors. We discussed about creditors are the suppliers who are giving goods for credit. So, they are interested in knowing the condition of the business. There can be creditors for goods, there can be creditors for assets. Both the types of creditors or money lenders even are interested in knowing the position of the business, as they expect not only the timely returns of their money, but are also interested in safety and timely return of the principal amount. So, they are deeply interested in credit worthiness of the business. Accounting information is a great help to them in knowing the short term and long term financial soundness of the business. Then comes government agencies. You know, government agencies have to look after the functioning of business organization for the benefit of public and society at large. These agencies have to see that all the business organizations are not engaged in unethical practices and are not misutilizing public money. So, for the purpose of proper discharge of their duties and controlling the unwanted activities of business organizations, they need accounting information. Next comes tax authorities. You know, we have to pay taxes, same is for business. Tax authorities are revenue watchdog of the administration. The taxes paid or payable by business largely depend upon the size of business operations and income or profit earned by business. The income or profit and the expenses or losses reported by business may not be true and their fairness is to be verified. For the purpose of calculating and verifying amounts of various taxes payable by a business, tax authorities also require accounting information. Then comes customers. The customers are serious stakeholders of a business, they are the base. The customers are also interested in accounting information because they wanted to be assured of the goods and services they are availing. Further, they may also be interested in knowing about the profit margin business is earning, so that they can come to know about the exorbitant prices business is charging for goods and services, if any. So, they require accounting information. Now comes employees or even labor unions. The employees of an organization are concerned about the stability and the growth of the job, which largely depends upon the profitability and solvency of the business. So, they are interested in accounting information of the business, which gives them an insight into earning capacity of the organization. Further, based on profitability of organization, labor unions can better negotiate the terms and conditions of employment, including remuneration, incentives, retirement benefits and other benefits. There are other end users of accounting information as well. Let us say there may be parties who are interested in accounting information of a firm for various purposes. For example, students, research scholars and research agencies, they require accounting information of various organizations for the purpose of their research. Further, prospective investors require accounting information of a firm for making their investment decisions. Likewise, prospective lenders and creditors also need accounting information of a firm for their respective decisions. Even competitors of a business require accounting information of that business for comparing their own performances with the business. So, all these parties are interested in accounting information of a particular business organization. That is all for the day. Thank you.